Hey there, community bankers. Welcome back to the Correspondent podcast from Independent Correspondent Bankers Bank. I'm your host, Madison Caplinger, Marketing Specialist with ICBB. Over the past few years, deposit strategy has taken center stage for community banks. With the Fed's rapid rate hikes, the competition for deposits has intensified and banks are feeling the squeeze. Balancing liquidity needs, funding loans, and staying competitive on rates without eroding profitability is no small feat. That's why I sat down with Neil Stanley, the CEO and founder of the CorePoint, a platform helping banks source fixed-rate deposits more strategically. We'll dive into the current deposit landscape, what community banks can do to stay competitive, and how technology can play a role in reshaping deposit strategy. Please welcome Neil to the podcast. Hey there, community bankers. I'm here with Neil Stanley, the CEO and founder of the CorePoint. How are you doing today, Neil?
I'm great, Madison.
Awesome. So, for those who may not be familiar with you and your work, tell us a little bit about yourself and your professional background.
All right, thank you. I started in banking in 1984, so a good long time ago. I worked with three high-performance banks, banking organizations, the First National Bank of Omaha, which grew to be the largest privately held banking company in the country. And then I worked for Northwest Bank, where I was the CEO. And I've held a lot of different roles, from Chief Credit Officer to Chief Liquidity and Investment Officer. Really was blessed back in the day to have a very robust introduction to the industry. We weren't specialized in certain fields. We really got to understand a lot about how the bank worked. And Madison, I came into the industry via academia, which is pretty unusual to be working on a PhD in economics and start as a bank trainee. That was definitely a hierarchical change of dramatic activity, because one moment I'm teaching an advanced class in economics, and the next I'm a trainee at a community bank. So I learned a lot. I ask a lot of questions, and a lot of what we do today comes from all those questions that we ask over time.
That's such an interesting story. I mean, it sounds, like it was humbling, but also that you came in with quite a bit of knowledge that would have been very valuable to a community bank.
It was humbling, but in a good way, in that it got me really grounded, because I knew, from an economic standpoint and a finance standpoint, I knew a lot about how business worked, but I didn't know how the bank functioned. And so I learned why you don't do third mortgages on ag real estate, because academically it makes sense. You could have a third mortgage. Why not? Until you see the practicality of trying to deal with all the parties involved and things like that. So, but there were certain areas of the bank where my questions were never answered. Like I told you about the third mortgage. I'm like, oh, these bankers know what they're doing when it comes to lending. But when it came to deposit strategies, there were so many things that, like, this doesn't make sense. And so that was back in the day. And then as time passed, I decided to, start a company to help bankers move through the decades, really, that they had just been stuck in the previous processes that they had done, just because it was legacy. It was just their historical traditions, and they were pulling out the playbook from yesteryear instead of actually looking at what technology would allow them to do.
So that is a great segue into my next question, which is just tell us a little bit about the core point. What do you do? What value do you offer?
So the core point was designed to bring a Bloomberg-like experience to retail banking. So when I was the chief investment officer at First National Bank of Omaha, I had a $2 billion investment portfolio that I managed. And that investment portfolio was something that I had a Bloomberg terminal, and I could look at all of the different aspects of that, the forward implied yields and option adjusted spreads. And I really got into the science of managing that investment portfolio. But when it came to the retail bankers helping depositors with their life savings, they had a rate sheet. Like, seriously, you're going to write 6 months, here's your rate, 12 months, here's your rate. And when somebody comes in and they're going to put $300,000 in the bank, you're going to hand them a rate sheet and a warm cup of coffee. I'm sorry. You should have more. So that was back in 15, 20 years ago. And so in 2010, I decided to build that Bloomberg for retail banking concept. And so we built the toolkit, we built the processes, the products, the platform, and the training and the results tracking that we call Core CD.
Awesome. I love that idea. Sounds like there's a lot of value added, especially right now for community banks. I think I shared with you before we started recording that one of the reasons I wanted to have you on is that, the last few years, what I'm consistently hearing from community bankers is, how do we get deposits up? How do we, grow deposits? Well, let's kind of start with the big picture there. How would you describe the current deposit environment for community banks? And what are some of the biggest pain points that you're hearing from bankers?
Well, it ties into what I said earlier, and that is that the pain is coming from bankers because for the years from 2009 until 2022, they had a surplus of deposits. In fact, in many cases, they were trying to get rid of deposits because it was ballooning their balance sheet, and they was trying to get rid of these funds. And so they deployed them in long-term assets, and that was, of course, a problem. But what happened was, as the world evolved so much, if you think about when the iPhone showed up, from the time the iPhone showed up until 2022, bankers didn't do anything strategically with deposits. They just opened the door and deposits came in. So all this technology, all this information was at the disposal of the counterparties, the depositors had all this information. Now, they were somewhat overwhelmed by it, but the big picture here is that bankers were flat-footed. When they started to need to attract properly priced deposits, they hadn't spent any time and energy. All the fintechs were focusing on payments and lending, payments and lending. They weren't focused in on deposit strategies. So all of the stuff that bankers had tried to keep up with was irrelevant when they needed to do deposits. And so they pulled out the playbook from 1990s and said, I know, we'll run new money only specials. We'll tier our deposits. We'll do things that we would have done 30 years ago and hope it works. And the big problem was not only do we now have the information from the internet, but now we have artificial intelligence. And AI is allowing people, typical people who don't have any financial training, to analyze optionality in ways that they were never able to do before. They just would get confused and go, I don't know, we'll just trust the bank. And they'll stay, the bankers would hope they would just stay in low yielding accounts. And they're finding that people are making decisions about how to manage their money in ways that they've never done before. So from a big picture standpoint, the bankers are very much in fast forward mode, trying to recover from all that time that they didn't upgrade their approach. And how do they deal with the multifaceted aspects of consumers, businesses, nonprofits, and governmental agents looking at this and going, wow, with Fed funds paying 430 or so, what should we be doing to manage our money? It doesn't make sense to leave my money in an account paying 0.1%.
Yeah, absolutely. I mean, I think nobody would argue that, as community bankers, we tend to, love our legacy and maybe at times be too attached to our status quo. And, at times, it serves us to be, very local relationship based, a little old school in that way. Um, but we kind of rely on the local relationship based uh, deposits. And I think you kind of alluded to this, but what challenges do community banks face with this mindset in competing with the larger institutions and fintechs that offer some of the things you said, better rates or more digital convenience?
Well, uh, Madison, I really enjoyed your last episode, that April 23rd episode, when one of your speakers said that banks are competing directly against the US Treasuries now for money market accounts. And they can go down and get a US Treasury for a 6-month T-bill, and it's liquid on a phone call. And that's what people are now realizing, is that yes, we care about our community banks, and we really want to do business with people locally, but the reality of having this optionality that the US Treasury provides and the rates that are being provided, it causes the banker to now be in a position that it's no longer just the legacy of, oh, people love the community bank and they want their money there. They really are responsible for managing their own finances, and they want to and need to take good care of it. So the bank, in competition with other banks, which we've always had, we've always known there are other banks out in the county or the local community, but it's not that just that anymore. It's fintechs coming in from a variety of different situations. Banking as a service, where there are a variety of different entities that are actually using a bank in the background, and you can put deposits in through them. So, Venmo, all of the different things that can disperse funds throughout our society. And the banks are not necessarily, particularly with the next generations, not necessarily assumed to be the place you put your extra money. So it really becomes a need to have strategy. Madison, to me, strategy is about anticipation and action. If you put anticipation and action into play, you're using strategy. And if all you're doing is relying on the tradition of, well, everybody's always banked with us here in the local community, we have a 60% market share and we'll always will have, I think that's naive.
Absolutely. And those two things you said, anticipation and I'm sorry, what was the other word you
In
used?
action. Yes.
Anticipation and action. Yeah. Do you feel like if you had to boil it down to one or two principles, those are the two things that make a really effective deposit strategy in today's market? Or would you answer that question differently?
Yeah, it's actually, I probably would use that with a couple other things. First, personalization, which ties right in, because you have to understand that people want and expect something other than just mass market stuff. They expect that you're going to understand more about them and their situation. So personalization is definitely a key part of dealing with this deposit issue. The second issue is understanding something beyond the classic. So the classic checking account, oh, that's your transaction account. Then your savings is your kind of slush fund, and then your certificate is your long-term savings. And that's all fine. We're not trying to take that away. But what you have to understand is, where's the optionality in those things? Because people now have options and they exercise options at a moment's notice. With the old cell phone, we now can go get something delivered to our house next day, and sometimes same day. And if the bank is resting on traditions about options, for example, um, the old-fashioned certificate of deposit, CD, people think they're locking up their money when they put it in a CD. Well, they don't want to put their money in very long if they're locking it up. Meanwhile, those treasuries that were referenced in your last episode, people will buy a 10-year treasury. Now, they don't buy the 10-year treasury thinking they're locking their money up for 10 years. They buy their 10-year treasury and they go, well, that yield is a yield I'm going to get. Plus, if I want to cash out early, I have options. I can find the market value of that 10-year treasury, and the market value might be higher than the principal amount. So a banker who's sitting there with the old-fashioned classic certificate is very vulnerable to competing against a market in which there's very efficient optionality for fixed income securities. And so we're really excited about the opportunities bankers have, Madison, to upgrade from the classic CD to a redeemable CD that works and functions just like a treasury.
Yeah, I mean, this sounds so common sense. It makes me wonder why, this isn't an option that bankers are employing more often. I mean, is it an issue that, they don't understand it's an option, or are there real drawbacks?
Well, there there are a sequence of events, Madison, that have caused the bankers to do what they do. So the first sequence is that the certificate of deposit was invented before calculators. Okay. So the idea of calculating the market value back in 1960 based upon present valuing the cash flow would blow your mind because there were no calculators and computers and all of that. The other thing, there used to be rules in the Federal Reserve that to qualify as a CD, you had to have a substantial penalty for early withdrawal. Those rules have been modified dramatically. And after the first 6 days now, the bank can do whatever they want. They can pay bonuses, they can charge fees and so forth. But there's a legacy understanding of, well, we can't touch that because of these various aspects. We've never done it before. There are regulations. And so there's a history, a long history of doing it the way we do it traditionally. And this is why that all that period of time from 2008 when iPhone showed up until 2022 when we needed deposits really paralyzed the industry because we became complacent. And so now when you're introduced with this challenge, there's an assumption that, well, there's a flaw here somewhere. Okay, you're telling me I should do it differently, but man, we've got a lot of history here. I feel like if we leave the safe harbor of historical activity, it's going to be risky. When in reality, what they're doing is highly risky because when you charge a 12-month penalty for early withdrawal on a 5% certificate, that's on $100,000, that's a $5,000 penalty. The irony of this is the penalties that classic certificates use goes up when you least need it. You don't really need to protect your 5% CD as much as you needed to protect that 1% CD. And if the penalty is based upon the interest rate, when you really needed a big penalty was when what rates were low and you didn't want that depositor to be able to come in and pull the money out. Now that rates are high, you're stating a big penalty. So it's a great question, Madison. I will tell you a little, it's not a secret, but a little insight. When I talk to bankers about this topic and they realize that I've spent 40 years on this topic, oftentimes they start to shut down and withdraw because they're bankers, they're experts at their industry, but this field is not something that they know that much about typically. And so when I engage them on it, they're like, he might embarrass me because he's talking about something I don't know that much about, and he seems to know a lot about it. What I have found, Madison, is AI is my ally because AI never acts like it's going to get embarrassed. And so when I talk to bankers about this topic, I find that they withdraw because they're like, I don't know, we're just going to do it like we've always done it. I'm like, well, okay, but let's debate this. But AI is very willing to debate me because it never has this sense of, wow, I'm going to get backed into a corner. And so this is just one of those little nuanced things that I find very interesting about our world today is that the consumers have AI in their hands. The bankers are thinking about AI mostly from being, should the bank use AI? And I think the banker needs to flip it around and go, what if our counterparties are using AI? What if our counterparties are asking artificial intelligence, hey, I've got a certificate, it's at 1.5%. Should I cash it out early, use that optionality, and take advantage of the bank and basically arbitrage them? The bankers need to stop thinking about AI as a tool they have and start thinking about AI being all over, being available to everyone in the ecosystem.
Absolutely. That's good stuff. And, I think you hit on, bankers, we tend to be kind of a risk averse group because, the job is managing risk, right? But I think we can often overlook, the risks of staying the same. And that's, to me as a marketer, that's very intuitive and prevalent. But I think community banking, we're so steeped in legacy, we don't always uh, think about that. So you talked about fixed rate deposits and optionality and kind of incorporating that. Do you think that is fixed rate deposits can help community banks stabilize funding with all of the volatile interest rate environment and all the uncertainties? Do you think that the personalization? Uh, do you think that's the role that fixed rate deposits can play in helping banks stabilize their funding?
It's a great question, and I know that the natural reaction as a banker. Now, again, I told you about sort of my academic entry into banking, but also I was the CEO of a bank, and I can tell you, any good banker says we want as much non-interest bearing deposits as we can get, always, always, always. We want overnight deposits because they tend to be much cheaper than term deposits. The challenge with that is we will never ever get enough to fund all of our loan demand by non-interest bearing deposits and inexpensive, in other words, really low yielding non-maturing or overnight deposits. So that means we're going to have to play in the term deposit world in some capacity, some level of activity. So they we need to look at that. We need to understand what our FHLB advance rates are in terms of the wholesale optionality. What could we go get in the wholesale market? And one of the things that I think bankers have realized in the last couple of years is that yes, you can outsource that aspect of your bank. In other words, go to the brokered market and get funding. But when you outsource, you're not creating any intrinsic value. You don't have any clients to work with. You can't cross-sell them anything. And so this notion that was around when interest rates were a quarter was, if we need funding, we'll just go get it from the wholesale market. It's cheap. Well, it was cheap until it wasn't. And when it's not cheap, you're just out there. You have no intrinsic value of being created, and you are really not using any of the internal uh, uh, strategies. It's just what does the market demand? So we need to understand that term deposits make sense, but you also need to be innovative about them. In other words, not just the classic CD, which penalizes people, but a certificate today. And Madison, this is part of why I think this is great timing on your part to have this podcast. A certificate today might have been issued a year ago at a rate of over 5%. And the innovators today are looking at that and saying, that depositor out there, if we keep paying them over 5%, we're paying above market. Instead of just waiting to maturity, why don't we make them an offer? We could say to them, you're welcome to keep the account with us, but you could cash that in with a bonus today. We'll pay you a bonus for early withdrawal. Now that blows the mind of most bankers because they've only heard penalty for early withdrawal. And of course, the word penalty means punishment. And none of us like to be punished, but we keep talking about penalties. We should be talking about fair valuing certificates. And if that's what treasuries do, and if you fair value the certificate today, an expensive certificate, you would be better off at the bank. You'd be better off by getting rid of that 5% account, paying a small bonus for early redemption. So using a new product, a new structure, a new approach that looks like treasuries, and communicating to that marketplace that you are not the stodgy old financial institution that punishes people. Instead, when it's beneficial, mutually beneficial, we do the right thing for you. Now, that's kind of a big idea, but then there are a lot of small ideas too, smaller than the redeemable CD, such as in today's world, why would you have to buy a certificate that matures 6 months, 12 months, 24 months, or 60 months from now? The reality is, if you go to any bank and ask, could it be that a certificate might mature on Saturday? Oh, yeah. Could it mature on Sunday? Yeah. How about next week, any day? Oh, yeah. How about next year? Well, of course, a certificate can mature any day in the next year. Well, if that's true, then why does a new certificate have to mature 6 months, 12 months, 24 months from now? Why don't you let the depositor select the maturity date, Madison? It just makes sense if you are thinking about it from a client perspective, as opposed to the bank perspective of that's how we've always done it. So what's happening here is the industry is grappling with the idea that deposits are important, and consumers and nonprofits and businesses and government entities like personalization. They like optionality. Let's give it to them and get in a position where we can compete without giving up value. Because basically, if we only offer the classics, then everybody has the classics. And the only way you win is to have a higher interest rate. That's not a good strategy.
Yes, as this is fascinating to me, first of all, but as a marketer, you're really kind of, speaking my language. And it sounds like, this customer centric approach with personalization and thinking through those kind of things are a really good way to to combat rate shopping, right? I mean, that's anathema to our long term deposit strategies. But I mean, do you think that this is the answer rather than trying to stay competitive on rates without also damaging the net interest margin, or do you think there's a little bit of both that could be at play with the strategy?
So good point. What we have found is that a lot of financial institutions will say, well, if we have better strategy, we don't need to pay attractive rates. Well, attractive, there's a whole spectrum of what might be attractive. You do not need to pay the highest rate to be attractive if you have a better product and process, but you do have to be competitive. So there are some things that you can do today that aren't rate focused, but they need to embed an appropriate level of price and promotion. For example, when someone, and this is something that your audience can take away and start doing today, if you have a certificate of deposit holder and they come in and they are dissatisfied with all your options, regardless of what rate you're using, they're dissatisfied. You might be trying to compete, you might be trying to lag on rate, but they say, cash me out, get me a cashier's check, I'm leaving. Every one of your clients, every one of the people in the audience today should have what we call a limited edition savings account. It's a back pocket savings account. Now, sometimes people, Madison, will tell me, oh, we have a high yield savings account. Well, not this. This is different, because the problem with your high yield savings account is you don't have the ability to personalize it. Now, people will say, oh yeah, but to get our highest yield, you have to have a huge amount of money. Well, it's still not personalization. If you're saying you have to have over $250,000 to qualify, you're basically putting it out in the market, or maybe you're using it as a back pocket and it's a secret account, which is problematic as well. So what we do instead is we have a product that we use anytime someone goes to cash out a certificate and they get introduced to a limited edition savings account. It's limited edition because it's only for maturing certificates. If you don't have a maturing certificate here at our bank, you don't qualify. But because you have a maturing certificate, you're going to get a loyalty bonus. You're going to be able to move all or part of that maturing certificate into a limited edition savings account. Now, this is not a certificate. So this rate is variable, but the depositor doesn't have a term. So they can pull the money out anytime they want. It's very well balanced. And the certificate holder who's negotiating on rate is coming at you saying, match or lose. Match the rate of your competitor or you're going to lose this deposit. You don't want to match, but you don't want to lose the deposit. Give them a high yield savings account. Now, what's high yield? Something less than Fed funds, because you still want to make money on it compared to Fed funds. But if you give them a yield of say 405 or 415 today, you're going to keep a whole bunch of those CD customers who are looking at that 460 rate or that 440 rate, but they'll keep it with you if you make it super easy to just move it into a savings account that pays them 415 today. But keep in mind, You can change that rate anytime, but they can pull the money out anytime. It's a great balance of optionality. We've been using this product, Madison, since 1999. It's a wonderful product, and it's like any other savings account, except it has a hold on deposits. They cannot deposit to it unless they have another maturing account at our bank. It's a beautiful product. And these are the kinds of things that we build into the structure so that you're not just competing on rate, you're competing on value, perceived value by the depositor. That's what's so powerful about these improved products that most bankers don't know anything about.
That makes so much sense. Okay, so my next question, it's entirely possible that the answer to it lies earlier in our conversation, but I
Okay.
am going to ask it anyway in case you have other things to add. So, how, in your mind, can banks use their fixed rate deposits strategically, not just as a funding source, but as part of a broader asset liability management plan?
Right. So the reality of when I approach bankers about some of these ideas, for example, the redeemable CD, they will say things like, "Oh, that's going to really change our interest rate risk." You go, "Well, yes, to the good, because the problem you have with your interest rate risk model is you've grown accustomed to the optionality that you've actually given." Remember, I talked about when the interest rates were really low and you had so many months of interest as the penalty. That was the time when the penalty should have been high. And so there are some things that because we've gotten used to them, we've grown we've grown to accept them. So when you actually step back and evaluate it objectively, you see untapped or undue risk. For example, had artificial intelligence like it's available today been around in 2020, think of how depositors would have taken advantage of banks as interest rates rose. Thankfully, most depositors didn't know how to take advantage of the bank and pull out those 1% accounts as interest rates went from 2 to 3 to 4. So the big issue today is getting bankers to realize that the world has changed because the artificial intelligence is going to allow people to make financial decisions like a professional would. And if you're a bank relying on people not being intuitive and logical, I'm afraid that might be a bad idea. So you need to invest in your people because you need people who are not order takers and product pushers anymore. Because well, let me just say it this way. I know this is a bias or I'm throwing in some of my own understanding here. But historically, as a bank CEO, I never had to go, Madison, to my lenders and boost their ego. They would tell me how important they were to the bank. The lenders were very good at telling me without them, we would not do well. But the retail team were very humble. And then I go, well, I'm just a personal banker. And I go, why do you say just a personal banker? You are critical to the success of our organization because you're negotiating with people who provide the raw material to our bank. Without deposits, we can't make loans. So a big opportunity right now is understanding that we don't need a whole bunch of product pushers and order takers. We need a few professionals who know how to negotiate with depositors. And we need good technology to support them in that negotiation. And so I think a big overlooked opportunity is elevating the retail banker. You don't need as many of them as you used to because you don't get that walk-in traffic like you used to. But you need people who know how to manage money and communicate how to manage money. And they're managing both for the bank and for the depositor. So they're not trying to give away the bank, but they're trying to get people to give the bank funding that can create profit for the bank, but respect what's going on for the depositor. There are always three categories of depositors, Madison. There are sleepers, and you can call them content. They're the people who don't really push you for a rate, and that's good. Let them be content. And then there are the curious, and the curious ask really good questions like, should I do something different with my money? And then there are the rate shoppers. And the rate shopper is the one who come in with accusations like, hey, why can't you keep up with Edward Jones? I'm going to leave unless you match the rate. That's not really a nice question. It's more of an accusation. So the front line of a bank needs to be able to address those issues in ways that are respectful and make sense for the bank's purposes and the depositor's purposes. And it's no longer a here's your rate sheet and a warm cup of coffee kind of world.
Yes, absolutely, to all of that. I think this has been a really awesome conversation. You provided a lot of insight. So I have one more question before we end here. And it's kind of a big, broad one, but what advice would you give to a bank executive or an ALCO committee looking to future-proof their deposit strategy over the next 12 to 24 months?
So the 12 to 24 months is an interesting time frame because, as we know, with all the tariff discussion and the Fed conversations, we don't really know what rates are going to do. But we need to keep our ear to the ground because material, we're not going back, Madison, to the trivial rates of yesteryear. I see us having material rates. I see us having these kind of conversations that we've talked about ongoing. I don't think it's going to go back to something like I've described 2010 to 2022. So I think the ALCO team needs to understand how their counterparties, those depositors, are going to use the discretion that they have to manage their money. I think you're going to have a generational, maybe not in 24 months, but over the next 5 years, a lot of money is going to change hands from the parents to the children and grandchildren, and they're going to manage that money differently. And how, as a community bank, are you going to show up when someone asks AI, where should I put my money to maximize the value of it? We need to really be thinking as the banking industry about how that is going to play to our advantage rather than our disadvantage. So to me, it's about having the right people, the right technology, an understanding of what markets are doing, and staying abreast of where markets are and pricing such that we are relevant. We always need to be relevant, and we need the personalization to make sure the right people are getting the right message at the right time. It's a big order. It's a tall order, but I don't see another way around it because the rate sheet and a warm cup of coffee just isn't going to cut it.
Very, very true. All right. Well, thank you so much, Neil, for coming on the podcast. I think you've given our, community banker audience a lot to think about and really a lot to work with. So thank you so much for coming on and sharing.
It's been my pleasure.
Thank you for listening to the Correspondent podcast from Independent Correspondent Bankers Bank. We hope you've heard something that you can take back to your community bank. Be sure to follow us wherever you get your podcasts. If you're listening on Apple Podcasts, leave us a rating and review, or on Spotify, turn on the notification bell so you never miss an upload. See you next time, community bankers.